Welcome back to the channel of truth, trust, and transparency. Today, I'm going to break down debt recycling for property investors and how people are using it to get wealthier and build their property portfolios with a couple of practical examples. Now, before I get started and kick off, YouTube has told me that about 72% of people that watch my videos aren't subscribed, so I would have really appreciated it. With such a small account, if you could hit subscribe so I can continue to be showing you and delivering great value in my videos. I would really appreciate it. Before I kick off, it's important to also remember I'm not an accountant. This is not financial advice. This video should be used for educational purposes only, and then you go into your financial advisors, your accountants, your mortgage brokers to ask them questions about this particular technique, this particular strategy, to see if it's going to suit you and your circumstances. Obviously, I can only run this off a make-believe scenario, so it might not be suited to you. I don't know your current position and where you're at. Let me walk you through how debt recycling works. Now, debt recycling only works if you have a primary place of residence. If you don't, you unfortunately can't utilize the strategy. The way it works, and it looks like this. Now, for all intensive purposes and for numbers' sake, I'm going to say as if you were starting out with a $1 million PPR, that's sitting at an 80% LVR, and you have $200,000 of cash. As you and I both know, the debt within your PPR is considered to be bad debt. Why? Because there's obviously no rental income coming on. Some people say it's also not tax deductive. Some people can say that's a bad thing. Others like the PPR for the safety, and that can be potentially growing in value depending on the area. But we all know we're buying the PPR based on where we want to live. That entire $1 million property is seen as bad debt. We've got 80% of it is the LVR is 80%. So this means I've got $800,000 loan, $800,000 loan on $1 million property. Now, as you know, banks really only like to draw up to 80% equity, which means they'll let you pull out equity up to the amount of $800,000. So if your mortgage, for example, is at $700,000, you would have $100,000 of usable equity. There are circumstances where you can go higher than an 80% LVR, but that depends on the deal and things like LMI and that sort of stuff. So for this particular example, $1 million property, that's your PPR, that's what you live in. You have about $800K worth of debt, meaning you put down a 20% deposit, or you've got 20% there worth of equity, and you got 200 grand in cash. Now, we know that this is bad. So essentially, the way that debt recycling works is people get the $200,000 here, and they pay it off the home loan. That means you go from having now zero cash. Now, obviously don't have zero cash, have a contingency, but 200 grand of working capital. 200 grand, they paid off the home loan. That means the debt on that home loan goes down to $600,000. Yeah? $600,000, meaning we have 40% or 400 grand worth of equity, and 200 grand of that is now usable equity. Because think, we went 800K, we paid the 200 down off the 800, which means it goes down to 600, and we have a lot of equity. We can only bring that equity up to 80% of the value. The value of the property is 1 million. We can bring 600 up to 800. Means we have 200 grand worth of equity, right? Now let's look at where we currently sit now. At a 6% interest rate, 6%, my repayments on $800,000 are going to be about 48 grand per year, which is what you're having to pay out of your pocket, because there's obviously no rent coming into your primary place of residence. If you're on 100K, that's a lot of money. Now that I've paid 200 grand off that mortgage, my mortgage amount is only 600 grand now. So I've reduced my mortgage and I'm only paying 36 grand per year in repayments. So I've decreased my payments $12,000 a year after I've paid that extra 200 grand off. Now, what do we do? And this is where the debt recycling comes into play. We have 200 grand of usable equity here. How? Because obviously, as I said, the bank will let you draw it up to 80 grand. The current debt's at 60 grand. We have 200 grand of usable equity. What people are doing is debt recycling, getting an equity release loan of that 200 grand, and we can split it now and purchase property. As I've put in my other videos, and as you'll see, go back through my channel, the purchasing price, what happens if you put cash in, what happens if you put equity in. But we can safely use 200 grand to purchase two $500,000 properties. Now, you're going to use that 200 grand and you're going to split it 100 grand each to get into two investment properties at a $500,000 value. How are you doing that? Obviously, we know with our deposit and our purchasing prices, it's going to cost us about $100,000 to get into a property worth $500,000. Now, I've documented that across other videos. You're more than welcome to scroll back through my channel to have a look. However, what we must remember is we've used $100,000, let's just say 10, 12% deposit, purchasing costs, but we'd have a loan of $450,000. We'd have a loan of $450,000 and we'd have 100 grand of expenses. But both of those are actually the equity loan. So our loans for each property are going to be $550,000 because we've got both the purchase price, 100% of it, and we've got the expenses to purchase that property. Now, let's run through some quick numbers on here. 550 grand is the total loan amount. We've got at 6%, that's going to cost us 33 grand in interest. And as we know from my previous videos on my channel, it's about $10,000 of expenses, letting fees, maintenance, insurance, council, water, all those kinds of things. About 10 grand extra a year. Now, for those two properties, let's just say a 5% yield. They're going to bring in about $25,000 in rent, and let's just say $5,000 we can claim in depreciation for those properties. So expenses $43,000, income $30,000, meaning we have a deficit of $13,000 per property. Okay, so now it's costing us $26,000 to hold these two investment properties. Now I want you to remember something. It's costing us $23,000, but now we can negative gear that against our income to see what our bottom line is at the end of the year. Let's just say I was on $100,000 and I was doing this myself. I'd pay $23,000 in tax, meaning I'd be left with an income of $77,000. If I take this $26,000 off my income, I then only pay 15 grand in tax, meaning my taxable income is $59,500, and I would get at the end of the financial year, I would get plus $8,000 back on my tax return. Why? Because my PAYG employer has withheld 23 grand in tax. That's the current 2025 tax rate for an income of $100,000. But really, the negative gearing part of it is meaning my income goes down to 1474 grand because these are negatively geared, meaning I'd only have to pay 15 grand in tax at the 74 grand income. But I've already paid 23 grand tax. So at tax time, I can get back $8,000. Now, because I get that 8 grand back, instead of it costing me 26,000 minus the 8 grand from it, meaning the property portfolio is now costing me 18 grand to hold, to hold those two suburbs, plus 36 on my mortgage, meaning all up, it's costing me $54,000 when here it was costing me 48. So for an extra 6 grand, I can use that and buy two investment properties. Now, here's where it gets a little bit better and we get into the weeds of things a little bit. Let's talk about the growth. If these properties grew at 7% each in the first year that I owned them, I would make $70,000. If they grew at 10%, I'd make $100,000. So now, and remember, I still own my PPR. So here, scenario 1 is owning a PPR, That's costing me 48 grand. Scenario two is I've got a PPR that's costing me 36 grand and I've got two properties that are costing me 18 grand. So all up 54 grand. So for an extra $6,000, I could be making 70 to 100 grand a year in the first year. Remember, that's going to compound again and again and again and be a larger amount as the values grow. You know, if they're up at 600 grand and I get 10% of growth, that's 120 grand. So for an extra 6 grand, you would do it. Now let's add on, and I always say this when I'm doing videos at the moment, because 6% interest rates makes things seem incredibly gross at the moment. $13,000 of holding costs. Now, if interest rates, my friends, came down to 4.5%, that's an average interest rate in my opinion. 6% I think is incredibly high, and I don't think we'll be at 6% for a long while. There's already interest rates in the fives. When it comes down to 4.5%, something much more palatable and acceptable and average, long-term average, these are only going to cost me $4,750 to own. So that's only going to cost me 9.5 grand. Meaning, once the properties grow in rent, $90 each, this will turn positive, or if interest rates get lower. So that will mean if either interest rates go below 4.5, I don't need to get the 90, but if interest rates come down to 4.5 and rents grew $90 a week, this portfolio would start to be neutrally geared. Now, this is the exciting part, because in 5-10 years time, as we go down the line a little bit and rents grow and interest rates come back, what's going to end up happening? These are going to start to get positive cash flow. What do we use the positive cash flow for? To pay down, my friends, the non-deductible debt. To pay down this amount here, this 36 grand. That is how you use debt recycling in a nutshell to build your wealth. Your properties will start to then pay for themselves. They can then, when they're in positive territory, pay off your mortgage whilst also retaining all three assets, compared to sitting on your bloody ass and just hanging around with one. Debt recycling in a nutshell. I hope I've covered it in enough detail. Let me know in the comments if you have any more questions. If not, as always, I'll see you tomorrow.